This is a download from BFM 89.9, the business station.
BFM 89.9. Good morning, I'm Roshan, Kanesan, and you're listening to Ringgit and Cents, the show that's all about personal finance. Now, Budget 2020 is going to be launched tomorrow, and before we get to that, I want to talk about the economy, possibility of a recession, and Budget 2020 and how all these things come together. Because there's a lot of talk about monetary and fiscal policy and fiscal deficits, but what do these things really mean? To help me with this, I have in the studio with me Dr. Carmelo Ferlito, Senior Fellow at the Institute for Democracy and Economic Affairs, otherwise known as IDEAS, and Director of the Center for Market Education. Welcome to the show, Carmelo.
Good morning. Thanks for inviting me.
So, Dr. Carmelo, let's start off with the basic question here. What's the difference between fiscal policy and monetary policy?
Fiscal policy and monetary policies are, in general, two instruments in the hands of public authorities to address the status of the economy and typically to address or to try to avoid or to cure recessions. Monetary policy is in the hand of the central bank, and when we talk about an expansionary monetary policy, means to try to increase the quantity of money available in the system, and it typically happens by lowering the reference interest rate. While fiscal policy is more directly in the hands of government and can take two big forms, tax cut or additional government spending. So these are the two macro categories.
So before we get to fiscal policy, as we will see in the budget tomorrow, let's talk about monetary policy, because we seem to be playing a cat and mouse game between this ever-present pending recession and central bankers cutting rates, which is very different from last year where the US Fed itself was more hawkish. Why do we perpetually talk about interest rates when it comes to this pending recession?
Well, there is in all the economics textbooks the idea that if the economy is slowing down, you lower the interest rate to give the signal to the system that borrowing money is cheaper and therefore is more profitable to launch investments. While when the economy is heating up with the risk of inflation, the central banks try to operate in the opposite direction, try to cooling down by raising the interest rate. Now, if you allow me, even if I agree with the basic logic behind this, I believe that a realistic approach to the economic system makes us to realize that the economy is like a living organism, and an organism which is complex and evolving over time. So to believe that there are such strong automatism, lower the interest rate, the economy flies, or vice versa, is, I believe, a bit simplistic and maybe even naive. So the economy is more complex than that. There are problems in implementing monetary policy.
Yes, because economic textbooks like to teach us that, if this happens, you do this, and if this happens, you do this. And the question on my mind, and I'm guessing a lot of other people's minds, is if it's that simple, wouldn't we have fixed the economy in permanence by now?
Yeah, in fact, if it was so simple, even my 5-year-old son could be the governor of central bank. But the reality is much more complex. And first of all, before addressing solutions, we should understand the causes behind the problem. Then what makes difficult both fiscal and monetary policy is the issue of time. So the central bank takes decision on data that are ex post data, after the facts. So when the data are available after the reality emerged, and probably when they are available are already old. Okay.
Yeah, because all this economic data is lagging data, GDP, it's all based on past information. And no matter what actions we take right now, it doesn't translate into live feedback, live action. So we don't really know if anything's working the way it's supposed to work.
So yeah, to work in real time is almost impossible. So data are available ex post, and data needs to be interpreted. So this is the reason why monetary policy is often not effective as we hope. The other reason, I think, that we have to be also very careful is that sometimes an expansionary monetary policy can be at the root of a recession rather than a potential cure. So to try to cure a disease with one of the causes is, of course, not possible, not advisable. Somehow the central bank, by lowering the interest rate, is launching a signal that alters expectations. Okay.
So when we talk about expansion, now that's a lot of talk around Budget 2020 being expansionary against the backdrop of a global economic slowdown. But the other big thing about any government's budget is the fiscal deficit. Now, before we talk about expansionary policy, let's talk about the fiscal deficit. Why is it important for a government to be fiscally responsible and maintain the fiscal deficit?
Is a bit like in a family. Let's say you know that your life will go through good moments and bad moments. So somehow, if you are responsible during the good times, then you have resources available when the bad times come. But if you keep on working on deficit, then when bad moments come, you are not ready to face them. You don't have available resources. Unfortunately, for fiscal deficit, we live on the theoretical heritage coming from John Maynard Keynes, who in a book published in 1936 claimed that if aggregate demand is sluggish, so there is no consumption or no investment, basically the government can simply compensate that, can balance that, and there will be a multiplier effect. So even if the government spending increase a little bit, the effect on the economy will be more than proportional. Again, this is the same like for the interest rate. I don't believe that such automatisms actually work because the economic system is complex. And actually also Keynes, to be honest, was prudent in advising this and was saying, okay, we can do this only when there are a lot of unused resources and when there are actually moment of difficulties. But after World War II, more or less all the world government took his prescriptions as prescriptions valid everywhere. So, okay, let's go for deficit spending, the economy will fly. And we know that this is not going to happen.
So the rationale here is if the economy is slowing down, we use the government coffers and pump the money into the economy. Either we start construction projects, we start whatever projects that we can think of to create jobs, to create spending, to create a multiplier effect. And we've been doing this for decades upon decades. I think since World War II, the new world economy has been built upon that idea.
Yeah, in fact, if you allow me to explain a little bit in detail, I think that the problem with generalized government spending is a problem of related with the complexity of the economy. The economy is ruled basically by preferences and expectations. Okay, so investors have preferences and expectations, consumers have preferences and expectations, and they base their activity on this. And these expectations are translated into a certain production structure and into a certain consumption behavior. When the government is pumping money, is somehow altering the structure of these preferences and the consumer habits because it is creating disposable income, okay? And there is indeed a multiplier effect because the money spent do not affect simply the industry that was helped, but create a positive, at least temporary positive domino effect on other industries. But the problem is, what happened when the stimuli finish because there are no more money and the economy needs to come back to its natural physiological size or dimension? We risk that the situation post-stimuli can be even worse than it was before, because it has expanded. The economy has expanded. Certain industries have expanded beyond their natural size, beyond the structure of preferences and expectations. Somehow has been injected with drugs. And what happens when these drugs finish? So when there is the withdrawal, then we have a problem. So the reason why fiscal stimuli do not have the magical effect that we expect lays precisely in this, that whenever action and interaction in economics has unintended consequences. So we cannot look simply at the short-term effect. We have to look what happened after that. But of course, this is here there is a conflict between the economic logic and the political logic. Political logic is, of course, short-run sighted, and economics try to look a little bit more in the long run.
So therein lies the problem. We stimulate the economy and hope that the economy can thrive on its own after that, but sometimes you need to keep spoon-feeding the economy to keep it going. And what happens sometimes when you stop spoon-feeding the economy? The threat of a recession. And we're going to talk about that in just a little bit, alongside other misconceptions that we commonly deal with. I'm speaking to Dr. Carmelo Ferlito, Senior Fellow at the Institute for Democracy and Economic Affairs, otherwise known as IDEAS, and the Director of the Center for Market Education. You're tuned into Ringgit and Cents, the show that's all about personal finance. Stay tuned. BFM 89.9, thank you for staying with us here on Ringgit and Cents, the show that's all about personal finance. I'm speaking to Dr. Carmelo Ferlito, Senior Fellow at the Institute for Democracy and Economic Affairs, otherwise known as IDEAS, and the Director of the Center for Market Education. Now, Dr. Carmelo, when it comes to recession, we've heard a lot about this year, and we were talking about how when you withdraw fiscal stimuli or monetary stimuli from the economy, we see it start to shrink again. But when we learn about economics in school, you learn about that it's a natural part of the business and economic cycle.
Well, I agree with the perspective that at a certain extent, business cycles are unavoidable, are part of the dynamics. I give you a simple example. We know about the bubble tea phenomenon. Okay, a bubble tea phenomenon, as I did in other interviews, can be described with a typical Schumpeterian framework of business cycles, and it will come the moment when the fever for bubble tea will not be there anymore. So let's look for a moment a little bit into the micro. Let's suppose that the government decide to support the bubble tea because consumers are withdrawing from consuming bubble tea because the fever ended. And so consumers are driven to keep on drinking bubble tea even if they would not do that without the government support. What happens when the government will withdraw the stimuli? It will happen that that readjustment that was about to happen earlier will have to happen, and might be even a stronger readjustment, a deeper recession, because the bubble tea industry has expanded beyond what was the dimension pre-stimuli. Translate this into the general economic system, we have the metaphor. So my point is that we need to give the possibility to the economic system to readdress its own problem. I believe that decentralized decisions are better than centralized decisions. When I talk about decentralized decisions, I mean the market system, where many actors are taking multiple decisions. Let's not forget that fiscal policy is decided by humans. Mm-hmm. We are not superhumans. So they can make mistakes. And probably few people can make more mistakes than many people when many people are engaged into a dynamic decision process like it happens in the market. So what the government probably should do is instead to create a framework in which the risk of recession is inferior. Okay, we have less chances, or let's say that we have like a corridor in which the economy move, which thanks to certain institutions, so the economy will not move beyond the lines of this corridor upwards or downwards. So we can design certain systems. In example, certain taxations, certain taxes can be part of such an institutional framework. A free economy, as free as possible, is somehow helping. Okay, so less regulatory obstacles can help. So this is where we should work. And if really a recession is coming, I believe, we should look at it more in depth, not simply looking at the GDP per se. Because I give you an example, ceteris paribus, if the GDP goes down simply because the government is reducing spending and reducing debt, can be even good. So is creating, maybe, okay, we have a contraction now, but this reduced deficit will help the economy to grow in a stabler way in the future. So look at the micro reality behind the macro aggregates, and then you can implement better framework and better policies to address the problems.
Okay, so what you're talking about is essentially a doctor looking at the cause of a problem instead of just treating the symptom and taking it to a much more micro level. That's very interesting. So instead of having maybe one central banker make a decision on behalf of the entire economy, break it down so that the market itself is helping that decision.
Well, I would go to the extreme point to say let's abolish the interest rate in the sense as a number addressed by central bank, and as prices are signals generated in the market, let this price also be generated in the market so that consumer and investors can try to combine their expectations via mutual interaction rather than waiting for the signals coming from central bank.
Dr. Carmelo, before we end, I want to talk about common misconceptions. When you look at the way we talk about the economy, what are some of the common misconceptions that you think are most prevalent?
First of all, I believe is the idea to always think in aggregates. So the consumption, the investment, the public spending, without looking at the reality behind this. In order to understand the economy, I had an old professor of mine that always invite me to look at the industrial bulletins. Look how the individual sectors of the economy are doing. So go into details. That I think is a very important point. The second point is the economic system is a living organism, so there are no automatic mechanism. Unfortunately, we have the idea that we can work on the economy like magicians, just do this, do that, and the lines will move on the graph like in the textbooks, but the textbook is a reference to understand certain trends. Reality is different because it's complex, and let's not forget the role of time that is often forgotten in economics. Time flows, and when the time flows, everything can change.
Yeah, what we learn in theory is for understanding, and I think that sometimes we forget that when we read something from our textbooks, we assume that it's going to be as clean-cut as that, and that's not usually the case.
No, it is not.
So, Carmelo, before this, you were telling me about this Center for Market Education, this where you are the director of, and talking about how you're planning to educate people about the economy. Now, I find this very interesting. Do you feel that we need to be educated about the economy on such that you started a division for this?
Yes, indeed. You just mentioned certain misconceptions in economics. We want to address them. And of course, we are not going to create a college, but we want to help people, and also specialist people, business journalists, to understand what's the economy beyond the textbook. I give you a simple example. Entrepreneurs are so important for the economy, but they are so absent in our textbooks. So let's talk about what is an entrepreneur, who is an entrepreneur. These are the things that we will try to address in the coming months with the CME.
Before we end, I want to ask you about Budget 2020. We're talking a lot about expansionary policy. And when it comes to expansionary policy, what are the key tools that a government can use?
We know that the key tools are either government spending or tax cut. In general, here before, actually, if I was the Minister of Finance, before launching an expansionary budget, I would try, as I mentioned before, to address which are the real weaknesses of our economy that maybe cannot simply be cured by spending money. So go more into the details of understanding the economy. And if I had to choose between government spending in a moment of difficulties or tax cut, I will, in general, think about a tax reform.
And on that note, thank you so much for joining me today.
Thank you very much. It was a pleasure.
I was speaking to Dr. Carmelo Ferlito, Senior Fellow at the Institute for Democracy and Economic Affairs. He's also the Director for the Center of Market Education. This was Ringgit and Cents, the show that's all about personal finance. Up next is the 10 a.m. news bulletin and then Enterprise. I'm Roshan Kanesan signing off for The Morning Run, BFM 89.9.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.